And last year in February, March, as I said, you started advising people to buy stocks. But now we're up 77%. At what point do you say, all right, I've made enough in this market, it's had its run, and it's time to get out?
Well, I'd start out by saying, you can't be wrong all the time. So, yeah, now, look, I mean, I'm still basically very positive, and some bad things happened this week in terms of this oil spill and Goldman Sachs, and the Greece issue is still up in the air. But the way I look at it, the earnings are really coming in strong in the U.S., and I'm talking about the U.S. market now, where it looks as though earnings for the second quarter will be 20% above what were already optimistic analyst expectations. So I think we're looking at $88 to $90 a share in S&P earnings for this year, and I don't see why they're not going to be 100 or maybe a little more than 100 next year.
Now, and let me ask you, Barton. That's pretty optimistic. How can you be this optimistic on earnings in the U.S. when you consider the issues that you just talked about? I mean, what you've got going on in Greece, what you've got going on as far as unemployment, what you've got going on as far as financial regulatory reform. Why would corporate earnings continue just to march on and post such high gains in profit?
Well, because the momentum of earnings is going to come from different sources, and I'm assuming that earnings of financial institutions may be under pressure, but on the other hand, to the extent that the existing single-family home market firms up, that's going to be beneficial to financial institutions, and Greece is a long-term event that could be very troubling, and that in the short term is troubling if the Europeans don't get their act together over this weekend. But it doesn't. It's not going to affect. I'm assuming that Greece isn't going to fall apart in the next 6 months, and that the market's going to be looking at earnings over the next 12 months of pretty close to $100 a share for the S&P. And unemployment, yeah, I mean, unemployment's always a lagging indicator. House prices, to a certain extent, are lagging indicators. And just as we were talking earlier, it's the old rule of 20, and that stocks ought to sell at whatever short-term interest rates are minus 20, or whatever the implied inflation rate is minus 20.